Picture this, you open your banking app on a brand new folding phone and see that six-figure balance you built. You feel safe, on track, comfortable. Now imagine that same number suddenly buys a third less of everything when retirement comes. Think of it as an economic bar fight where global trade deals are swinging fists, and your retirement pint gets knocked over. Tariffs are a quiet pickpocket no one in Washington likes to talk about. A stealth tax on your future. We're pulling back the curtain, how these policies sold as protectionism erode your wealth. Stay with me. We'll walk through history, inflation, volatility, and what you can do right now. This is not partisan drama, it's financial reality, and it's affecting your retirement every day. Imagine tomorrow, everything at Target or on Amazon is 5, maybe 10% more expensive. No vote, no town hall, just baked-in prices. That invisible add-on is a tariff. Politicians call it protectionism, economists call it regressive. Everyone pays more, even if you didn't vote for it. Remember 2018, a 25% levy on imported steel. Sounded tough, looked patriotic. By the time supply chains adjusted, American-made washing machines jumped about 12% in price. In 2025, we saw duties on everything. Textiles up, shoes and apparel could spike nearly 40% in the short term. Analysts say the average household could lose over $2,000 a year to these price hikes. Your retirement dollars are forced onto a diet, same paycheck, less purchasing power. Inflation is the compounding thief. $500,000 in 30 years looks a lot smaller in today's dollars. At roughly 3% inflation, that $500,000 feels like $371,000 in 10 years and $275,000 in 20. Tariffs are classic cost-push inflation. Companies raise prices to cover new import taxes. Producer costs rising mean consumer prices follow. Your $500,000 still stares back, but buys less. August 2025 inflation hovered around 2.8%, but producer costs showed acceleration. A warning sign. Your account still flashes $500,000, but the comfortable life it promised, it's shrinking. That's the silent theft, compounded, gradual, and hard to reverse once it bites into your nest egg. Tariffs don't just nudge prices, they spook the market. Markets crave predictability, tariffs are chaos. In April 2025, new tariff announcements sent the VIX above 60. Panic levels from the COVID peak. A headline about new semiconductor or EV duties can make the S&P drop 2% in a day. If you're 65 and withdrawing income, a crash forces you to sell at low prices. This is sequence of returns risk. Bad early returns when you withdraw can doom a plan. A client texted me, "My IRA just shed $40,000 after tariff rumors. Retirement delayed. It's a brutal, real-world double whammy. Inflation eats purchasing power, while volatility forces bad selling decisions." If you're young, a dip is a discount. Buy the dip. If you're near retirement, it's a catastrophe. Tariffs also raise everyday costs. That money you plan to invest might be eaten by higher living expenses. My 63-year-old client said, "My plan to retire next year is out the window. I'm working until 67 now. 2 extra working years, not because of poor choices but a headline and a policy shift. That's the human cost. Delayed freedom, postponed plans, less time with family. Proximity to retirement changes everything. Time amplifies both risk and the need for defensive planning. Think Social Security COLA will save you? Not so fast. COLA for 2026 projects around 2.7%. COLA uses CPIW, which underweights expenses retirees actually face, especially healthcare. Tariffs on medical imports can quietly push Medicare costs up. A higher COLA can backfire. Higher premiums and taxes eat the raise. You get less net benefit. The check goes up, but deductions can mean you keep far less. That illusion of safety is fragile. Tariffs can indirectly increase your healthcare and tax burden. Chip away at the safety net you counted on. The classic 4% rule. With $500,000 withdraw $20,000 the first year, adjusted for inflation. But if tariffs push inflation to 5% or more, that $20,000 buys what $16,000 once did. You face a terrible choice. Slash lifestyle or withdraw more and risk running out of money later. Higher withdrawals may solve today but dramatically raise long-term ruin risk. Your retirement vision, travel, family time, starts to look bleak under sustained tariff-driven inflation. But there are defensible strategies we'll cover next, ways to protect purchasing power and flexibility. You can't control trade policy, but you can control diversification. Spread your risk across assets, own companies with pricing power, staples people buy regardless of price. Add tips for inflation protection, REITs for rent escalators, and foreign funds to reduce tariff exposure. Some emerging markets may benefit as supply chains shift away from tariff-heavy zones. Diversification won't be bulletproof, but it reduces single policy concentration risk. Think global, act diversified, and tilt toward assets that hold value as prices rise. Second, hoard liquidity. Cash is not trash, it's an airbag. In late 2025 you can find high-yield accounts north of 4%, safety plus yield. When tariff headlines wobble markets, cash lets you avoid panic selling. Keep 6-12 months of expenses accessible to ride out short-term shocks. That cash is also dry powder, a chance to buy quality when prices drop. Defensive and offensive. Cash cushions you and creates opportunity. Treat it as mission critical. Third, be like water. Ditch rigid 4% dogma for dynamic withdrawals that adjust to market reality. In down years take 3%, in good years take 5%. Protect principal when the market is weak. Use free online dynamic withdrawal calculators to model your plan and set guardrails. Tighten in bad years, splurge in good ones. Your future self will thank you. Flexible withdrawals reduce sequence risk and preserve longevity of your funds. Be adaptable. Let market performance guide spending, not panic or rigid rules. Fourth, max out while you earn. Tax-advantaged savings are your best defense. For 2025, the 401k limit is $23,500 with catch-ups for older workers up to new special levels. Every pre-tax dollar shields purchasing power from inflation and potential future taxes. Also use IRAs and catch-up contributions. Maximize both pre-tax and Roth where possible. Yes, it's harder when prices rise. That's why it matters more than ever to prioritize savings. A small percent more today compounds into big protection against tomorrow's tariff storm. Pro move, tax diversification. Don't just save pre-tax, mix in Roth accounts. Pay tax now, withdraw tax-free later. A hedge against unknown future tax hikes. Tariff-driven inflation can increase political pressure for higher taxes to fund programs. Roth withdrawals won't count as income for certain Medicare premium tests. That's powerful. Split your contributions across account types to create flexibility and tax optionality in retirement. Tax diversification is a strategic insurance policy against policy-driven shocks. Nobody wants to work longer, but working smarter can be an advantage. Delaying Social Security 2 years can boost benefits roughly 16% permanently. Consider part-time consulting, teaching online, or a small creator business, less tariff exposure. 2 more years of saving and compounding can increase your nest egg by 10% or more. Work on your terms. Choose flexible, lower-stress income to bridge gaps. Working longer needn't feel like a penalty if you structure it around meaning and flexibility. Feeling overwhelmed? Start with one simple step. Find a real return calculator online. Plug in your current nest egg and a 3% inflation assumption to see purchasing power in 20 years. Drop that scary-looking number in the comments and see how yours compares and get honest feedback on how to fix it before it's too late. If you want more unfiltered financial truth, hit subscribe. Break the headlines down before the rest of the world catches on. Drop your thoughts below and let's get practical. I'll help you map the first action. Tariff wars are slow-motion muggings, but you can protect your pint with 5 steps. 1. Diversify globally and across asset types. 2. Build a 6 to 12-month cash bunker. 3. Flex your withdrawals to avoid sequence risk. 4. Max out tax-advantaged accounts while you earn. 5. Keep the option to work a little longer. Smarter, not harder. You can't stop the fight, but you can protect your pint. Drop your real return number in the comments. Subscribe for more. I'll guide you through this.